to have some very meaningful dialogue with three of the best guests that we have probably had together in the studio itself. Let me introduce to you Mr. Mickey Doshi, the Managing Director and India Country CEO of Credit Suisse, Neelkanth Mishra, Managing Director and India Equity Strategist at Credit Suisse, and Ashish Gupta, Managing Director and India Head of Research at Credit Suisse. Basically, the Credit Suisse Brain Trust is with us. Gentlemen, welcome. We are deeply honored that you have dropped into the studio at a time when, as we have been speaking, there is this liquidity versus valuation battle going on. The government itself is 2.5 years, basically halfway into its term. A very good time to analyze how things are poised for the economy, for the country, and indeed for the global situation as well. Mr. Doshi, let me start with you. Thank you very much personally for coming in. What's the, you are in daily touch and for the last 30 years with a whole lot of foreign investors. We have been getting good foreign flows for the moment, just as the whole world has been getting. But do you think the India story is still ticking very well with global investors? Should we expect to be on their right side?
Lata, thanks for having me on the show. I think you're right. This last 6 months of flows have been, what, $3 billion of net FII flows into India, in line with probably the rest of the region. Having said that, my belief is that we will probably see more than the emerging market flows others would get. And I think the story remains relatively intact, independent of what you were saying earlier, liquidity versus valuation. And I'll let my colleagues talk about valuation in a bit, which probably may be looking a bit stretched. But at the end of the day, I think we will see, I do believe India is the spot where we will see money coming in more than the rest. So yeah, I remain optimistic of the country. Why I remain optimistic is probably, I'm sure, is what you'll be thinking. I think clearly, reforms, if people believe haven't happened, are on its way. I think vis-a-vis the growth story, India remains stronger than the rest. And I think, other destinations probably have, opportunities. But I think the way the government's operating here, I kind of do believe that we will see more.
Okay, Mr. Doshi, hi, good morning. The other interesting thing is that if you look at the global picture right now, for world over, liquidity is so strong that investors seem to be buying bonds for capital gains and equities for income. So the world has turned upside down. Post-Brexit, we have seen this phenomenal move. Do you think we are building some kind of bubble somewhere in the in asset classes?
So I think post-Brexit, obviously, one of the things which we have seen, interest rates have come down sharply and bonds have, we've seen that happen. I think the fear of Brexit, the initial knee-jerk reaction happened. I don't think we have absorbed all the impact of Brexit. So I think to an extent, possibly globally, is there a worry we should still be worried about? I think I do believe I would still be worried about global asset prices and the global scenario. I think India hopefully should be shielded from that to a great extent. I think being a standalone consumer-oriented market ourselves. But yes, netted, I would say there would be a bit of a worry.
Well, Neelkanth, just to extend that point, it's not just valuation versus liquidity. The IMF yesterday downgraded, or day before yesterday, downgraded growth of all economies, global economy as well as US economy, European economy, Indian economy. And yet you are having, this equity market climb. And to be fair, on the other side, you've also had good bank earnings in the US, signifying that something is right in the economic recovery as well. Which will pull and go ahead? Will the growth slowdown prevail ultimately, or maybe in the near term itself?
No, I do think that that there should be a growth slowdown. I mean, there will be a growth slowdown. I mean, all the signs are that the uncertainty triggered by Brexit is already resulting in people holding off on investments and so on and so forth. There is a lot of uncertainty. In fact, there are other stress points. I mean, we only look at the yields on bonds, but look at insurance companies, pension funds. I mean, there are large pension funds which are now printing 0.5%, 1% gain on their assets when their expected gains are 7.5% a year. And this has been like 2 years in a row. So pension funds will start showing stress. So the point then becomes what will fail, right? The thing that I know from looking at the markets over the last decade is that the failure will come at points that we are not expecting them to, right? So we are watching CDS spreads of banks, we are watching sovereign yields, we are looking at all the things that we have, emerging market currencies, but I think the shock will perhaps come from somewhere else. Now, the bigger point is at what point do equities start showing some of this stress? And I think that equities are actually growth proxies. Right now, what we have seen is a knee-jerk reaction of the valuations catching up. I think a lot of insurance companies, pension funds, etc., are, I think, almost afraid of running out of bonds to buy. I mean, you must have seen how central banks are hitting limits of, and therefore, they need to be buying these bonds. In terms of relative attractiveness, the equities are looking better. So we've seen that. But when this starts affecting earnings growth, I do think that at least in the developed world, you will see equities starting to come down, and that will pull down our relative benchmarks. Which is why on the Indian market, at least in the near term, I would stay a bit cautious, because I think the economic growth also for a few months, because of and we have seen some companies report that in their numbers, the economic growth also will slow down for a few months. The year-on-year comparisons will not look as attractive, and I think the market will have to slow down as well. But I do think that on a 1 year, 2 year basis, I would remain quite constructive.
Okay. So, Neelkanth, good morning. So, how should one approach the market right now? Because it's now trading above median valuations. 70 to 80% index stocks are trading above median valuations. Do you now seek the comfort of stocks where the growth hasn't been there, but there is at least valuation comfort, or do you stay invested in some of these outperformers? That's the catch-22 situation right now.
So, so in terms of PE multiples, we are not just above median valuations. We have been higher than this only 4% of the time in our history, right? So we are talking about very, very high multiples, but on a relative basis, we are actually quite okay. So if you look at the earnings yield gap of India versus the 10-year US bond yield, it's still at 4%. It's been higher than that only in stress points, right? So I think that on a global asset class, I don't think we need to worry too much about absolute valuations per se. Our preference has been for being into stocks that have good earnings growth visibility, and that means, unfortunately, still some of the high PE stocks. We have, in the last 3-4 months, upgraded some metal names. We have pushed very hard on some utilities because the valuations are low. And I think after the 14% underperformance over the last 3 months, maybe there can be select IT stocks which actually can give you good trading returns.
Oh yes, Hindalco was one of the calls that Credit Suisse made 6 months back, and we have seen huge returns in Hindalco. So that, of course, has been quite phenomenal. Ashish, hi, good morning. We've seen quite a bit of rally in, of course, banks as well. The first point that I want to discuss with you is this, whole bank recapitalization. How are you looking at that? There's one camp which believes it's throwing bad money at the, or throwing more good money at the bad. Would you have a different view on that?
See, I think what has happened is that the government has limited choice. It needs to support these banks, and the money needs to come in. And in fact, our belief has been that if you see the money coming into the bank, so the amount has been largely similar over the last 2 years, but more of the money is going into weaker banks because they need to have the minimum threshold of capital adequacy. So I think there is little choice with the government not to put in the money. I think the only choice is, or the only other alternative is whether they privatize or not. But if they are not willing to go down that route, they just have to support them with this amount of capital.
Okay, I will come to you about your very famous House of Debt report and the corporate health tracker, which I think has become now the Bible even for regulators. But before that, let me just complete this Hindalco argument that Anuj started, simply because the health of the metal sector will determine the health of the financial sector to some extent, at least for the steel stocks. What's your sense, Neelkanth, when we last met, along with this Hindalco argument, you were speaking about how much restocking can push up metal prices and therefore give Indian companies a lease of life. There is some, of course, policy help also that they have got. Do you think metal companies are in a position to pay up their interest? Is there some kind of valuation comfort there?
So those are completely unrelated issues, right? So, so the debt levels in many of the companies is beyond redemption. I mean, so if you even if you give them mid-cycle EBITDA per ton, they have to write down at least half of their debt. So that is unsustainable. The longer they stay in that position, the unsustainable part of debt continues to go rise. So the steel cycle revival is only, I think, applies in the stock markets to companies that are not down in the dumps, right? And so that call continues to work. I mean, I think we have seen steel prices in China revive. Iron ore is at 60. So that restock, and then now we are seeing that companies are slipping up on their iron ore shipments. We have seen after the trade barriers were moved up in India, in Europe, in the US, the Chinese perhaps have realized that continued exports are not the way forward, and they're also being much more serious about consolidation. So I think the trends are quite positive. So the good thing is that we should not see new companies go down that route. There was a fear that almost all steel companies will go down that route. That's not going to happen. What is also possible is that if there is a company with 45,000 crores of debt, where earlier the sustainable number was 20,000 crores, maybe now the sustainable number is 25,000 crores. But 20,000 crores still has to be written down, right? And that 5,000 crore gain goes to the banks, which is why around the same time we upgraded the metals, we also upgraded some of the banks. So that remains our thesis. That hasn't changed at all.
Okay, upgrading of the banks. Actually, that is what I wanted to come to. But I have a lot of questions on that. We have a mandatory break to be taken. And then a lot of questions on how to face the financial sector from our Credit Suisse team. Back in a minute.
The market absolutely flat, but that's if you're looking at the Sensex and the Nifty. The mid-cap index is where the party is. The index is up about 0.5%. Ms. Doshi, the other point is that from investors' point of view, 2.5 years back when we had this huge rally, there was a Modi premium built into the market. You talk to a lot of these global players. What's the sense you get? Are we on the right path as we complete 2 years of the government, or is there something more that they expect now?
Okay, so when he first came, Anuj, when he first came to power 2 years ago, we had a government for the last 10 years, which was the same government, and obviously one of the key things the message which the global environment wanted to see, global investors wanted to see, was is there a change? And I would have to categorically say, from a perception perspective, there has been a big change, right? I think India was not a destination which people are looking at as closely. It clearly has become one, may it be in the capital markets, may it be in the FDI purview, may it be in terms of even M&A activity. If you look at what we have done in the last 6 months and how active we've been, inflow coming in. So I think the global investors, yes, I think are positive. I think they have had a, clearly low oil prices and the economy doing performing the way it has helped our cause. But at the end of the day, all the events put together have attracted the capital. Going forward, my perspective is it remains still attractive, as I said earlier. Will we need to show more? Yes. A lot of what the government has done is not going to see the benefits overnight. Now, some of the changes announced in the last few weeks, hopefully we will see an immediate impact. And one of the big ones, actually, which I was quite impressed with, I was disappointed with the last 2 years, which hadn't happened, was disinvestment. We just announced last Friday the Suti sale. Now, if it were to go through as they say it is, that's about $8 billion of disinvestment, right? So, that would excite me. I think that's one of the things which I would be quite hopeful. I would want to see happen more over the next 2.5 years, because the rest of the reforms, I think, are much more longer term in nature in terms of seeing, hopefully in this generation, but clearly it's a longer term impact, not necessarily in the next 2.5 years.
Okay. Now, speaking about the next 2.5 years itself,
yes.
Probably in the next 2.5 weeks, we will get the GST amendment bill passed. And we hear from the government that by December, they should be able to get the states also to pass the model bill, or at least a large number of them. Will that be seen as a big game changer? I'm only talking about perception now. I know the implementation will take time, but will that keep us on the top of the emerging market basket?
Yeah, I think so. I think there were two aspects of, one was pure perception, and the second was action, right? In terms of action, like a lot of the actions are clearly long term. I think the short term actions people wanted to see was bank recapitalization, bank management changes, GST being passed, land reform bill being passed, and the GST was obviously struggling because of the government's inability in Rajya Sabha. And if they get it through, yeah, I think clearly it will be something taken as a very positive sign. So yeah,
I
I'm optimistic.
noticed that you didn't mention the bankruptcy code, but I really want to speak about the banks.
That's the other positive too. Yes, absolutely, and that's something which I think.
Yeah, Ashish, considering that, Neelkanth has been arguing that at least you immediately for the next year, perhaps, we are not going to see commodity prices grow to that 2015 levels. Yes. Has a line been drawn in terms of stressed assets? Is all the known are the devil only what is known?
Sure. No, I agree. I think now most of the stress has a good amount of visibility. It may not all be classified under the head NPA, but if you look at the NPA, restructured, watch list, 525. So if you aggregate all those numbers, I think the total stress asset portfolio comes similar to what our numbers are. And the second point definitely is that with the metals rally, some of the loss given default on these stress asset has also got capped. Right. The challenge, however, is that banks are not fully provided for it. So there are some banks that have the capital to provide for it, some banks which are shy of having the capital that is needed. And that will be the big challenge over the next couple of years. So as some of these assets move from the restructured or the watch list buckets to the NPA bucket, you will need additional provisions. And in fact, many of the banks to start off just even on the NPA bucket don't have adequate provisions. So I think we definitely have visibility on what is the total quantum of the problem is, but yes, we still have to go through taking the financial cost of it.
Okay. Neelkanth, just to carry forward the argument, we're talking about banks, but the real sector which has done remarkably well is NBFC, and you still have overweight on that. And we have seen good growth, of course, in all parameters. But do you get a sense that things are in exuberance phase right now? So many of these stocks are now trading at 3 times, 4 times, 5 times price to book.
Correct. So we have been downgrading some of the names as well. In fact, one of our top sells now is an NBFC. But to put it in context, see, NBFCs are where a lot of the innovation is starting to happen, right? And so using of data to lend, to bring down your risk exposure. They're also beneficiaries of this sclerosis in the banking system, where despite, see, all the arguments that were earlier given, oh, liquidity is too tight, we can't cut rates. Now the liquidity is also eased off, but we haven't seen any banks cutting rates, right? And if you see the bond yields, they continue to fall. So they are the biggest beneficiaries of this expansion in the yields versus the bank rates. So yeah, I would say that they, and from a policy perspective, till 5 years back, the RBI and the government was afraid of letting the NBFCs grow because there was this control fetish, sometimes justified, that if there's something which is not supervised on a daily basis with 15 different ratios, it is very, very dangerous for the economy. But the new establishment, the current establishment in the RBI and thankfully in the government seems to be much more comfortable letting the NBFCs grow, and actually they're becoming part of the policy toolkit. So, we remain very positive, but selectively, because there are stocks where I think there are 40-50% downside to our target prices, and there are also some of them are, they will always be, you can have a macro tailwind, there will always be boats that will somehow, screw things up and then sink, and you have to be very cautious, so loan against property, people start going overboard, and so we are seeing signs of that already. And therefore, we are selectively downgrading some of these names as well.
Okay. Ashish, what is your, there is a valuation comfort. Like you said, the negatives are out. Yeah. And therefore, there are a lot of public sector banks that are being valued at 0.2 times book to maybe a maximum of 0.8 times book. Sure. So do you have, therefore, a valuation reason to recommend buys in any of the top-rung public sector banks and even in the private sector, the corporate-facing banks?
Sure. So we do like most of the private sector banks, even the corporate lenders. And the reason, as I mentioned earlier, is the fact that we believe they have the capital to take the provisioning cost that is going to come in, right? And in the public sector bank, the challenge is that while on a nominal basis, the valuation may look cheap, but if you build in the true cost of provisioning and the capital, then they are not as cheap as the numbers you have mentioned. And we believe going forward, the other big challenge these banks will have is on the technology front. And literally, it will be a double whammy that at the time when pace of change is accelerating because of the technology, these banks are getting distracted on their NPA issues, on their capital issues. And this is going to be, in fact, I believe the next 10 years is going to be the time when there will be a huge acceleration in pace of change in the financial system in India, right? And in fact, we believe there's a huge $600 billion market cap opportunity up for grabs. And who are the guys who are best placed to grab it? And in fact, that goes to the earlier question about NBFCs as well, that yes, definitely the valuations are high, but if you look at the growth opportunity in the consumer and SME market, that is very, very large. And till now, we had been constrained by the lack of data to lend to these markets, right? So if you want a consumer loan, the first thing a lender asks you is for your income tax return, right? If 30 million people only file a IT return, your consumer market is restricted to that. But now as you get multiple new sources of data, your market size can expand to a much larger scale. And we believe it can be 5 times as large as currently just in the next 10 years.
Oh, absolutely. Actually, we had Vaidyanathan of Capital First even speak to us about some algo-based, well, not algo-based, but regression analysis-based lending that he is doing, where due diligence can be much less because of the stats. But I wanted to discuss more about that report. In that tailwind report of this huge unified payment interface, payment banks, Aadhaar, all of them coming together, the big opportunity will be in the mid-cap space. I mean, the Equitases and probably the others that are yet to come to market. So would you really go down that path? All the microfinance institutions, some of them listed, some of them yet to be listed or shortly to be listed. Is that the place where the money is to be made?
I think there will be multiple places where the money will be made. And I think the biggest winner on this whole new development will be platforms that attract more and more customers on their platform, right? So the person who captures the information is really the owner of the customer. Till now, customer ownership was defined as having your or mine savings account. And that is going to change because even though my savings account may be with one bank, I may be more flexible in doing transactions with other counterparties. And therefore, the customer ownership concept will change from having a savings account to having data about the customer. So the real winner will be, whether it's a fintech company or it's an NBFC or this bank, is the guy with whom individuals transact more and who have the data.
Okay, let's do one thing. We'll take one more break and we'll come back and discuss some more aspects with the Credit Suisse Trust team at this point in.
Welcome back. Well, market's still in flat terrain and we are enjoying that because we are having an extremely useful, more medium range and long range conversation with the brain trust of Credit Suisse, Mickey Doshi, Neelkanth Mishra and Ashish Gupta. Well, we have to swerve away from financial, not because we have run out of questions, but we may be running out of time. Neelkanth, how are you looking at the traditional defensive piece, IT and pharma? First pharma and then IT are going into this huge downturn. Is this value time in both these spaces?
See, we when we upgraded the metals and some of the banks, we actually cut our overweight on IT and we went into marginal underweight about 3-4 months back. And that seems to have played out well. I mean, the reason for that was not that we somehow thought fundamentals were changing in IT, but we thought that opportunity was much bigger elsewhere. And IT and pharma for the last 3 years have been the favorite hiding place, and they are global businesses, very professional management. They have also become of scale, at least in the pharma space. They weren't of scale till 10 years back. Now, I think what has happened over the last 2 years in pharma, because of, I would say, the FDA issues and so on and so forth, and I think a lot of froth that was building in, because people were giving 20 times multiple to what were actually one-off earnings, right? And as some of those one-off earnings have come off, people have said, oh my God, I don't understand this. So I do think that there is value emerging again in some of these spaces. They remain some of the, if you look at the IT sector valuation versus the market valuation, it's actually at a 5-year low, right? So the IT, what was a 50% premium 5 years back is now a 10% discount. So, so I do think that, at a time when people are really hunting for cheap ideas, good quality, well-managed companies, these are starting to. But, I don't think all the derating, I wouldn't go and buy all the IT stocks. There are some stocks which are particularly beaten down where I think value is visible. Same, I would say, is on the pharma side as well. But I still don't think all the froth has gone out of the system.
Okay, a couple of IT stocks have managed to bounce back from the lows. Neelkanth, the other space which has been in unadulterated bull market is the oil marketing companies. And they are getting their fair share after a really long time. Do you think these stocks can surprise on the upside, just like they did on the downside over the last decade?
I continue to think so. So I think they are still cheap. They have still offer very good dividend yield. They've been among our top picks this year, and they have done remarkably well. And I don't think we're done yet. There is a lot of disbelief. When we started pushing them hard, we found that this was actually, from the sell side perspective, a consensus buy, but no one wanted to talk about them because they had been, so the investor appetite was very low. They thought they were government-run companies. They would start giving subsidies again, and so on and so forth. I think that at a time when there is good oil volume growth, and I think over the next 10 years we should continue to see that. Maybe not 10%, hopefully not 10%, but good growth. And I still think that they're actually pretty cheap. They are investing much more wisely. Earlier, the biggest fear from PSUs used to be that when capex happened, a lot of money would get siphoned out. I think the chances are that this time those risks are also much lower. They may still mis-execute because they have execution issues, but I don't think deliberate siphoning of cash is going to happen. So investors can feel much safer. So I think that run, they've run up very well in the last 3-4 months. So maybe they'll take a breather. But if you're looking out 1 year, I would still be a buyer of those stocks.
And finally, you all have done seminal work on state government budgets, as well on sectors that others have not touched so far, like your annual farm series, where you looked at how much of horticulture is happening, cold chain is happening, dairy farming is happening, probably because of the cell phone and the Gram Sadak Yojana. Can you tell us a little more about that? How will a stock market investor relate to this kind of groundswell of state spending and consumption revolution?
That's a very big challenge for us, and that's a very interesting problem to solve. That I continue to believe that the central government, using the famous Indian tradition of using Atishayokti Alankar, that you exaggerate to drive home a point. Okay. I don't think the central government matters as much as the state governments, right? I think they matter, and that's why I'm saying I'm exaggerating. State governments are, and so if you meet a government employee, 30 out of 31 times you're meeting a state government employee. And going through the state budgets over the last 2 years, I've been amazed at the kind of ambition that is emerging in the states. So Telangana wants to give piped drinking water to every household, right? Once you think about it, you wonder why everyone doesn't think about it. And let's see if they are able to do it. It's a 40,000 crore project. UP is thinking of doing metro rail projects in Kanpur, Agra, Allahabad, Meerut and Varanasi. We are seeing Rajasthan move to conclusive titling of land, right? So there are states which are willing to give presumptive clearances to projects, right? So these are...
Will they be able to implement? Is there money, bandwidth?
So let's see. See, at least now the ambitions are starting to get set. No, I think, the first thing is to desire, right? And the fact is that the political winds have changed. People have some of the money to spend, so the state budgets are expanding. They are and also starting to take on much more challenging projects, which is, I think, a remarkable positive. And one of the reasons we have seen FDI bump up so much is because the state governments are allowing a much more easier access to projects. Now, how do you translate that into the stock markets? I think you have to be very creative. One, you have to start looking at state-level nuances. So some of the largest consumer companies have started looking at state-level planning for marketing strategies, very, very localized ad campaigns and so on and so forth. So you will start seeing companies that are emerging from particular states. You will also start seeing much better indicators in terms of oil consumption, in terms of electricity consumption, and they will be beneficiaries of that. So one of the reasons we have been so comfortable with, say, a coal manufacturer or a utility is that we are comfortable that household electrification is picking up, and therefore power demand over the next 5 years can be strong, and therefore coal that is being produced can be consumed, and therefore buy a coal stock. Or an oil marketing company, if the oil demand continues to rise at high single digits, that's the best way to play it. So you will find opportunities that rely on more bottom-up growth. But you need to be very, very careful in translating some of these actions into earnings.
Mr. Doshi, final question from my side for you. Over the next 2 months, of course, the next big decision from government side would be the successor to Raghuram Rajan.
Yes.
Do you think the choice of individual would matter, or do you think the RBI legacy is going to continue in terms of the kind of policies that we have seen?
That's the million-dollar question, and you're looking for the million-dollar answer. I think it's a combination of both, right? I think there's always been a legacy at the RBI. There's no doubt about that. We've had changes every 3 to 5 years, depending on the term. But having said that, the individual will also matter. And there have been a bunch of names which have been discussed in the public forum. All of them clearly have credentials to be in that seat. I think it's a combination of both, to be fair. I mean, that would be my answer. But the institution is in place, and the deputy governors are in place too. So it's not as if it's going to be without any leadership, old leadership. But I think it's a combination. But we're all looking forward to it, bated breath. I think there's enough money being put on
There's a widespread expectation that it will be a dovish appointee, combined with a set of dovish decisions. For instance, the FRBM target could become flexible, a range. The MPFA, the Monetary Policy Framework Agreement itself could allow for higher inflation. And of course, the governor appointee himself could be known for dovish credentials. How would you expect the market to respond? There is a near-term positive in that, but should we see that as positive?
I think the market generally, I mean, we would want it to think very long-term, but I doubt that the market has the capacity to think really 3-5 years out. Markets, as I said, reflect growth. Whatever may be the risks to the currency and inflation expectations, rates, etc. I do think that it will be growth much more than anything else that the markets go for. If you get a governor, I doubt that, so you have to be very careful that an individual who appears a certain way before becoming RBI governor could act very differently once the person becomes the RBI governor. So I won't extrapolate from past behaviors, because once you become the RBI governor, it's a very responsible position. And I think we demean the role and the individual when we think that he'll somehow go and do the government's bidding as the RBI governor. That I don't think will happen. Therefore, I mean, I would not extrapolate from the person. But yes, if the behavior is dovish. But on that point, let me also make a point that I think, given how the monsoon is progressing, that inflation will come down meaningfully starting December. Okay. And so whether it's a dovish governor or a hawkish governor, you will see rates coming down.
Okay. Well, on that positive note, since there are a lot of growth impulses that you guys see at least in the next 1 year, thank you very much, Ashish, Neelkanth and Mr. Doshi, for joining us. It's been one of the most rewarding half hours that we have had on CNBC TV 18.